All right, so Vera Bradley just dropped their Q2 earnings. And let's just say the market was not a fan. So today, we're going to give you the full Talk Tickers briefing. We'll break down the numbers, look at their game plan, and then give you our call on what's next. Let's get right into it.
So, here's what we're covering. First, we'll hit that initial snapshot of the quarter. Then we're going to dig into the numbers behind the narrative. After that, we'll look at management's big 5-point turnaround plan, check in on how the market is reacting, and then, we'll wrap it up with our call on the next quarter.
Okay, first up, VXRA's Q2 snapshot. And let me tell you, it was a tough morning for shareholders. The reaction to this earnings release, it was fast and it was brutal.
Yeah, look at that. A 10% drop. The stock plunged 10% in pre-market trading right after the announcement. I mean, that really tells you all you need to know about how investors felt. No matter what positive spin management tried to put on it, the market's first vote was a huge, huge thumbs down.
So here's where it gets kind of weird, right? This is the big conflict of the quarter. On the one hand, you've got an EPS beat. They lost 2 cents a share when the consensus was for a 15-cent loss. That sounds good. But, and this is a big but, that beat happened because they slashed costs, not because they sold more stuff. And then you look at the other side, revenue, a huge miss. And for investors, that top-line number, that's what set off all the alarm bells.
All right, so let's get into the nitty-gritty. Section 2, the numbers behind the narrative. We're going to unpack this top-line trouble. Okay, these numbers, wow, they are pretty stark. Total revenue didn't just dip, it completely fell off a cliff. We're talking down almost 25% year over year. And comp sales, that super important metric for retail health, cratered by more than 17%. Now, there is one tiny silver lining: gross margin actually held up. But honestly, that's totally overshadowed by the absolute collapse in sales.
And this chart, this right here, shows you the core of the problem. Their direct business, their own stores and website, that was weak, down about 16%. But look at the indirect channel. That's their wholesale business. It was an absolute catastrophe, down over 52%. That means their retail partners, think department stores and little boutiques, basically cut their orders in half. That is a massive vote of no confidence from the people who sell your product.
Now the balance sheet. It tells the story of a company that's really feeling the pressure. They had to draw $10 million from their credit line just to keep the lights on. Inventory is down, which, okay, that's a small positive. But the biggest red flag on this entire slide is that last point. They gave no forward guidance. In the investing world, when a company does that, it screams that they have no idea what's coming next. And you know what? The market hates, absolutely hates, that kind of uncertainty.
So you see these awful numbers, and you have to ask, what's the plan? What's management going to do? Well, they laid out a pretty detailed 5-point strategy. They're calling it their playbook for a revival. So this playbook, it really covers the whole shebang. They're talking about sharpening the brand, creating a better shopping experience both online and in-store, completely revamping their outlets, even changing how they work and operate. It's a comprehensive list, for sure. But let's be real, it's also incredibly ambitious.
Now, amidst all this doom and gloom, management was really eager to point out some, green shoots, some signs of life. And this quote from the chairman is a perfect example. Their Gilmore Girls collaboration, it's sold out in 5 minutes. That's insane. It proves that when they get the product and the marketing right, the customer is still there, wallet in hand. But, and this is the billion-dollar question, can they do that over and over again and at a much bigger scale?
And it wasn't just that one thing. There were other bright spots. They're bringing back some classic bags, which is smart. The Disney and Peanuts collabs did well. And check this out. A social media push got them a big surge in followers and a 23% jump in new customers on their website. So management is basically pointing to all this and saying, see, our plan is starting to work, even if the big numbers don't show it yet.
Okay, so that's what's happening inside the company. But now let's pull the lens back and look at the bigger picture. Let's see how Vera Bradley is doing compared to the rest of the market. And yeah, this chart tells a pretty brutal story. Just look at the one-year performance. VRA is down a staggering 58%. At the same time, the retail sector as a whole is up almost 22%, and the S&P 500 is up almost 16%. So they aren't just lagging the market, they are literally going in the complete opposite direction. It's not good.
And that brings us to the key question that every investor has to be asking right now. Is Vera Bradley a deep value opportunity, a diamond in the rough that's just waiting for a comeback? Or is it a classic value trap,
A stock that looks cheap, but it's cheap for a reason, and it's just going to keep falling as the business struggles. Okay, so that brings us to our final section, our call. We've looked at the numbers, we've looked at the plan, we've looked at the market. Now it's time for the analyst's verdict.
After digging through everything, it's time to put our stake in the ground.
All right, here are our predictions for next quarter. First, revenue. We think it's going to keep falling year over year. You just can't fix a wholesale problem that deep in 3 months. For EPS, we actually think they'll manage to get close to break even, but only by continuing to cut costs like crazy. And the stock price? Well, with no guidance and investors being so skeptical, we see it being stuck in a range, maybe even drifting lower, especially if there are any more bad surprises.
So based on all of that, our official rating on Vera Bradley is underperform. What does that mean? It means we expect the stock to do worse than the overall market. And we think that's going to be the case until management can prove, not just say, but prove that the revenue free fall has stopped and that this turnaround is the real deal.
And finally, let's talk about our outrageous but plausible trade idea. The thesis is simple. The market has it right. For now, this thing is a value trap, not a turnaround. So the trade? You could look at long-dated put options. It's basically a bet that the stock is going to keep falling over the next few months. If that turnaround plan doesn't gain traction, and especially if holiday sales disappoint, this trade could really pay off. The big catalyst to watch for would be another weak Q3 report.
And as always, we have to end with this. This is not financial advice. Thanks for tuning in to the Talk Tickers briefing.